Welcome to the Deep Dive. We're the place that takes that flood of earnings call information and really boils it down for you.
Trying to find the signal in the noise.
Exactly. And today, we're looking at a really closely watched one in green energy. Plug Power. PLUG is the ticker. We're digging into their Q2 2025 update. That call happened August 11th, right after the bell.
Yeah, and this one felt pretty critical, Yeah. Plug Power, it's not just about growth anymore. It's really shifted. Now it's all about execution risk, unit economics. For a long time, the market just kind of accepted the losses, right? As long as they were building things.
Building capacity, yeah.
But now, the skepticism is, well, it's intense. This Q2 call was a big moment for management to show they're actually getting disciplined.
And you could really see that skepticism in the market's reaction, couldn't you?
Oh, definitely.
Before the call, options were pricing in, a 12% to 17% swing? Huge implied volatility.
Massive expectations.
Then the numbers actually drop, and the next day, the stock moves negative 2.5%. Barely a ripple.
Which tells you so much, right? That flat reaction. I mean, it says investors saw the progress. Okay, but they are just laser focused on the quality of those earnings.
Not just the top line number.
No, they want proof. They're waiting for that real inflection point, not just, more promises about things getting better down the road.
Okay, so let's hit those hard numbers that caused all this tension. Top line first.
Yeah, go for it.
All right. Revenue, $174 million reported. That was a clear beat. Consensus was looking for $158 million.
Good, significant beat.
And that's up 21% year over year. So demand, clearly not the issue here. People want their products.
And there's always a but with Plug, it seems.
Yeah.
The bottom line is where that execution risk really showed up. The GAAP EPS, that's generally accepted accounting principles earnings per share, it came in just a bit worse than expected, a loss of 16 cents per share.
Versus expectations of a 15-cent loss. Okay.
For listeners maybe not totally steeped in financials, GAAP EPS is key because it includes all the stuff like stock-based comp, depreciation.
The real cost of doing business.
Exactly. Gives you the truest picture.
And look, when you're a growth company that's still burning cash, every single penny on that bottom line matters. A revenue beat says, hey, we can sell it, but an EPS miss says, yeah, but it still costs too much to make and deliver.
You nailed it. And that leads us straight into the big strategic fix they're pushing. Management calls it Project Quantum Leap.
Right. Heard a lot about that on the call.
Yeah, it's not just tinkering. It's supposed to be this big, comprehensive 3-year thing. They're talking aggressive cost cuts on the products themselves, streamlining manufacturing, and just getting way better at service execution. Fixing things right the first time.
So moving from just building stuff to actually running a business efficiently.
That's the goal. It's trying to become a commercially viable operating company.
And that transition, that's what's supposed to fix the margins. And the margin numbers this quarter, honestly, they're kind of shocking.
Yeah, this is the headline, really. If you go back just 1 year, Q2 2024, Plug's growth margin was, it was terrible. Negative 92%.
Minus 92.
Right. Now, fast forward to this quarter, Q2 2025. It improved dramatically, sequentially, and year over year to negative 31%.
Okay, hold on. Negative 31 is still losing money on every sale, but moving 61 percentage points in a year, that's huge.
It's a massive swing.
But the critical question is, how sustainable is that? Is it real systemic change or just, some temporary belt tightening?
That's what everyone wants to know. Management did give some specifics, which helped. They pointed to 3 main drivers. First, better hydrogen pricing. They've got new supply deals. That feels structural.
Okay.
Second, aggressive cost reductions on the products, particularly their stack technology, so engineering improvements.
Right, getting cheaper to build.
And third, better service execution. They claim they're getting better at maintaining the equipment already out there without these super costly fixes all the time. They actually said that the service side, is the fastest way to show profit at the unit level.
Okay, so if they're getting costs under control, what's the target? What are they aiming for this year?
They were very, very clear on this, repeated it multiple times. The big goal is hitting gross margin neutrality. So break even on a run rate basis by Q4 2025.
Break even by the end of the year.
Yeah. They kept calling Q4 the tipping point. If they hit that, it totally changes the story. It goes from can they survive to, okay, how fast can they scale this profitably?
Huge difference. All right, let's look under the hood at revenue. Where is the growth actually coming from? Which parts are strongest?
The standout is definitely their core tech, the electrolyzers.
Yeah.
That segment, they call it GenEco internally. It hit about $45 million in revenue this quarter. That's nearly triple what it was a year ago.
Wow, okay. So real demand for the hydrogen generation equipment itself.
Absolutely. Customers are buying the tech, even with the overall company still working on profitability.
And based on that strength and across the board, what's the outlook for the full year revenue?
Management said they're basically on a pace now that's consistent with hitting around $700 million for the full calendar year 2025.
Okay, decent clip.
Which naturally leads us to the question that always hangs over.
Yeah.
Plug. Liquidity. Cash.
Always the elephant in the room.
Yeah. For a company building all this infrastructure, the market's constantly asking, do they have enough money to get there without just diluting shareholders into oblivion?
So what did they say? What's the cash situation look like?
They finished Q2 with over $140 million in unrestricted cash. Now,
Doesn't sound like a huge amount given their burn rate.
it's not a massive cushion, no. But they really emphasized their access to more capital. They confirmed they can tap into more than $300 million in additional secured debt capacity. It's under existing credit facilities.
Okay, secure debt. And the key part there, for investors worried about dilution.
This was important. They specifically stated that getting the second tranche of that $300 million does not require them to issue more shares.
That's big, takes away that immediate dilution fear.
It removes a major overhang.
Yeah.
Plus, they're doing stuff internally, too, trying to manage cash better. They talked about leveraging working capital, aiming to reduce inventory liquidation by at least $100 million this year.
Getting cash out of inventory makes sense.
And they're still winding down those old power purchase agreements, the PPAs.
Right, those deals that tied up a lot of capital.
Exactly. Those were long-term commitments to buy power. They're shedding those. And they expect that wind down frees up something like $200 million in cash commitments annually.
Okay, so several levers they're pulling to manage cash.
Yeah, the goal is to bridge the gap until they hit positive EBITDA, which they're still projecting for some time in 2026.
All right, let's shift to the regulatory side. Management sounded pretty bullish here. Said recent clarity is a big catalyst, giving them visibility into 2026. This is about the U.S. tax credits, right?
Yeah, huge tailwind potentially. We finally got long-term clarity on two really important credits. First is the 45V production tax credit, the PTC, that basically pays you for producing green hydrogen.
Right.
Per kilogram.
An operating subsidy.
Right. And second is the 48E investment tax credit, or ITC. That one helps pay for the actual equipment up front.
Okay. So clarity is good, but how does that translate into orders now? Why does it motivate customers today?
Because it removes uncertainty. If you're a customer and you know for sure you'll get a significant chunk of your equipment cost back via a tax credit, you're much more likely to pull the trigger on an order.
Makes sense.
And for Plug's material handling business thing forklifts, that 48E ITC extension is apparently really powerful. Management expects a big surge in bookings in the second half of this year, 2025.
Why the second half specifically?
Because customers can now plan effectively. The credit kicks in when the equipment is commissioned, put into service. So they'll place the orders late this year, Q3, Q4 maybe, knowing they'll take delivery and commission it early in 2026 to capture that credit.
Ah, got it. So it allows management to look at orders coming in now and confidently project their 2026 revenue pipeline.
Exactly. Gives them that forward visibility they were talking about.
Okay, speaking of pipelines, let's talk global execution. Those big electrolyzer projects especially. How's that funnel looking?
They described it as robust, particularly strong interest in Europe. And strategically, they're trying to lock in deals before the final big money decisions are made. They called it securing pre-FID agreements, final investment decisions.
Locking in value early. Smart.
Yeah, secures their place, helps them plan capacity.
Any specific projects they mentioned? What's closing soon?
They mentioned some smaller UK projects closing this year, 2025, but the really big ones, the major FIDs, those are mostly expected in 2026. They spent a lot of time talking about Iberia, Spain, and Portugal, pointing to anchor projects like a 25-megawatt deal with BP and a really substantial 100-megawatt project with Galp in Portugal. They said they're actively quoting on gigawatts worth of projects across Europe. So yeah, seems like they have a solid foothold there.
And back in the U.S., the Texas facility is a big piece of their domestic hydrogen network plan. What's the status there?
Yeah, that's key infrastructure for them. They said construction is targeted to start by the end of this year, 2025. That project is tied to that huge 310 megawatt power agreement they have with NextEra.
Big power deal.
Right. And tying back to the cash concerns, they also plan to bring in a partner for that facility, financial or strategic, by mid-Q4 this year.
Sharing the capital costs.
Exactly. Part of that strategy to manage the cash burn while still building out.
Okay, so this deep dive. We've covered a clear strategy with Project Quantum Leap, this massive improvement potentially in gross margins. Let's switch gears. It's time for our purely analytical segment. And let me just stress this heavily. What we're about to discuss is high risk, it's speculative, it is absolutely not personalized financial advice.
Definitely not advice. This is us putting on our hypothetical hedge fund hats.
Right. Thinking about an outrageous but maybe plausible trade idea based only on the information from this Q2 update.
Okay, so the whole premise here is betting on that narrative shift we talked about. Plug power is, well, it's famously volatile, and it usually carries a pretty high short interest. Lots of people betting against it.
Right.
Management has drawn a line in the sand, that Q4 gross margin tipping point.
Aha.
Break game. If they actually hit that target, the whole story could flip overnight. Goes from high-risk builder burning cash to potentially viable industrial company with improving economics.
And that kind of narrative shift from survival to actual unit economics, that's prime fuel for a massive short squeeze, right? Given the history and the shorts involved.
Exactly. So the trade idea is basically a leveraged bet that management can actually execute over the next 2 quarters. And interestingly, because the stock didn't explode after this Q2 report, that fear premium, the implied volatility, kind of got crushed. Volatility is relatively lower now than it was pre-earnings.
Okay. So how do you play that?
Well, the speculative idea would be to look at long-dated, deep-in-the-money call options, maybe looking out to 2026 or even 2027 expiries.
So you're buying time and leverage.
Right. You're buying leverage when vol is relatively lower, betting specifically on that Q4 milestone being hit.
And the potential payoff is a huge run-up if they deliver and trigger that squeeze.
That's the concept. It's highly leveraged, highly speculative, betting on an asymmetric outcome. Your downside is capped at the premium you pay, but the upside could be, well, enormous if they actually deliver on Quantum Leap and hit that Q4 goal. It's a pure bet on execution.
Okay, so let's recap this whole deep dive then. We saw clear strength on the top line. Revenue growth proves demand is definitely there.
Healthy demand.
We saw a really, honestly, impressive jump in gross margin sequentially, moving from that awful negative 92% up to negative 31%, driven by this Project Quantum Leap focus on efficiency.
A major directional improvement, at least.
And then finally, these big policy tailwinds, the ITC and PTC tax credits, that seem to be giving them real confidence in their sales pipeline converting into firm orders for 2026.
Yeah, all those pieces are there. But the fundamental question, the one for you, the listener, to really chew on is this. Can this company, which for years has basically been defined by building stuff, by capacity expansion, can they actually make the transition to being defined by execution, by boring old operational discipline?
From growth story to operational story.
Exactly. Making that switch from just growing capacity to actually achieving sustained profitability, that's the make or break hurdle. It's what will ultimately decide if the current valuation makes sense and if that Q4 tipping point becomes reality.
A really powerful question to think about. Thanks for joining us on this deep dive into Plug Power's latest quarter.
And yeah, just one last time, this is purely informational. Nothing here constitutes financial advice. Always do your own research.